Hello, I'm Bernard Hickey from interest.co.nz and welcome to a special economic weather report from here at the Reserve Bank in Wellington, where the Reserve Bank has just put up the official cash rate by 0.25% to 2.75%. The Reserve Bank has argued that the economy is recovering by itself and that it's time to reduce some of the stimulus going into the economy, essentially to take its foot off the accelerator. It's not quite putting it onto the brake this time around because, frankly, others have helped the Reserve Bank do its work. Higher bank funding costs because of the global financial crisis and the bank's own desire to raise money from term depositors is helping to push up funding costs and therefore interest rates without the Reserve Bank having to do much. However, the Reserve Bank has decided to push up the official cash rate anyway, in part because we're seeing strong commodity price growth, which is going to boost export returns. We're also seeing some inflation pressures starting to bubble up from below. The Reserve Bank has pointed to an expected spike in inflation next year because of the increase in the GST, an increase in the emissions trading scheme costs, and increases in ACC levies. Inflation will go to about 5.4%, albeit briefly, next year. The Reserve Bank will choose to look through this one-off increase, but it says that it will be putting up the official cash rate over the coming couple of years, or at least it's forecasting that with its 90-day bank bill track. Now, currently the Reserve Bank is saying the 90-day bank bill rate will rise from around about 3% currently to around about 6% over the next couple of years. That implies that the Reserve Bank is going to put up the official cash rate from around 2.5% to 5.5%. So what does that mean for anyone with a floating mortgage rate or has some money in a term deposit account? Well, currently floating mortgage rates are around about 5.8%. You'd expect the various banks to put up those floating rates by around 25 basis points sometime in the next few days. For anyone with a $200,000 mortgage, that's going to put up your costs by about $10 a week. Now, over the next couple of years, given the comments from the Reserve Bank today in the June quarter monetary policy statement, we would expect the official cash rate to rise by about 3%, and that puts floating rates up to about 9%. If you've got a $200,000 mortgage, that's an extra $115 a week or so. Term depositors are going to see their rates rise as well, potentially even more than that 3%. And that's because banks are so keen at the moment to get their hands on term deposits. And it's amazing, really. Term deposit rates are actually about 200 basis points, full 2% above the official cash rate. Now, if that's the case, we'd see the term deposit rates rise from around about 4.5–5% now to something like 7.5–8% in a couple of years' time, if we carry on the current track. Now, there are a couple of conditions or caveats that the Reserve Bank has pointed out. If we see a real financial meltdown in Europe and an effect on global trade and on global financial markets that increases bank borrowing costs even further, that could upset the apple cart and get the Reserve Bank off that continual track of slow increases in the official cash rate over the next couple of years. Those are the things to watch, at least. The Reserve Bank Governor was relatively confident about the global economic outlook and about New Zealand's outlook, saying the recovery was self-sustaining. But he said now's the time to make sure that inflation doesn't come back in a couple of years' time. I'm Bernard Hickey. That was a special economic weather report from here at the Reserve Bank in Wellington. This was brought to you in association with the BNZ.